Hello everyone and welcome to your Glassnode video report for week 50. I'm your host Checkmate and we're recording this on the 14th of December 2021. So we have continued to see fairly weak price action across the board. Bitcoin has really been struggling. It traded between about 45,000 and 50,000, and at the time of recording this it's really testing the 200-day moving average down at about 46,700. So it really is testing that fairly well-known and well-observed 200-day moving average, generally defines kind of a line in the sand as the bull-bear line. So that really the bulls do need to step in and really start to show some strength. And what we're going to look at this week is a bit of an aftermath on what happened after last week's deleveraging. It's important to kind of pay attention to this balance between derivatives markets and spot markets. So we're going to have a look at that transition, what the overall derivatives markets are looking like now. Do we have increased probability that derivatives will step back in? Are we going to see another leverage flush? Or is it more moving into the on-chain space? So we'll explore that balance. We're also going to look at things like the flow of funds from and to exchanges. And then we're going to look at the NUPL, or the net unrealized profit and loss metric, which helps us really define whereabouts in the market cycle we likely are, and where that kind of bull-bear line is. And then we'll also close out with quite an interesting metric that's now part of our preset workbenches, which is the market realized gradient oscillator at a 28-day basis. Now, this is actually a metric that I myself put together, so I'm probably the best person to actually talk about how it works. And it's one of those really interesting tools that there's a lot you can pull out of it from a fairly simple concept. So let's jump into it and get started with the analysis. So here we are in our week on chain 50 dashboard. We can see that we've had a fairly severe correction, right? And we are continuing to consolidate. I mean, really, Bitcoin is just hovering above this price. And at the time of recording, the 200-day moving average is about 46,700, and we're currently testing that. And that's really going to make the bears and the bulls, they're going to have to fight for this level, right? The bears are trying to push it lower, and the bulls are trying to step in and provide that support. So it really is kind of hanging in somewhat of a balance. It's obviously not the greatest price action. There's a lot of macro forces that are driving this. But what we're going to try and use is all of the data and all the information at our disposal to just try and assess the overall health of the market, where certain risks can start to step in, and just how the market's performing between a derivative and a spot-led market. So to start with derivatives. Now, last week we really focused quite a bit on the derivatives market, and the reason we do this, I like to use a terminology like the dog and its tail. Now, for the most part, the spot and the on-chain markets are the dog. That's essentially wherever the market wants to go is essentially following the dog on its lead. Now, sometimes the tail can wag just a little bit too hard, which is the derivatives markets, right? You get this buildup of excess leverage, and it really doesn't matter what's going on in the spot markets. You can have a very, very slight trigger, which is what we saw last weekend, and the derivative markets have to flush out. There's too much excess leverage, too many stop losses, and too many liquidation levels super close to the price. And we can see this in our futures open interest. This is across all exchanges. You can see the dramatic drop in overall. It's about 25% was flushed out within the span of a couple of hours, but certainly over the course of that day. Now, what's important to note is we are getting a bit of a climb up of the open interest. Now, what that generally means is that more and more people are opening contracts, and they're generally going to have a stop loss or a liquidation price close to the current price. Now, you can note that every time we've had these very, very high levels above 375, 400,000 BTC, this is all priced in BTC, you can see we had the same up here in the Coinbase IPO, so that was the all-time high, which we then had to flush out. We had high open interest as we flushed out in May. We had another bout of high open interest. This was actually a short squeeze. So people were betting that the market was going to go lower here in late July, and we actually squeezed them out to the upside. And we then have a very sustained period. Note how long this actually lasted. We had one at this high, and then another bout just after the all-time high at 69,000, which then flushed out. So the way to really think about this is that a very, very large amount of open interest is showing that there's more and more contracts being opened close to the current price, and therefore any large volatile move, either to the upside or the downside, can trigger some kind of a flush out. Now, we are seeing a bit of an increase. This is a metric that you'll be paying attention to over the coming weeks. Do we get this continued increase in open interest? Are we seeing more and more people actually jumping into the market and pushing this thing higher? Because that would start to suggest that maybe we have the potential for another flush out. But right now, it's climbing, but it's nowhere near the kind of massive short or long squeeze type level. Now, in terms of the directionality of it, we've got our perpetual funding rate. We've got one that maxes out all the different exchanges. You can see how volatile they all are. And it really does depend which exchange that we're looking at. So we've got our dark blue line here, which is kind of the mean or the average across all of those exchanges. And then we have our kind of resolved value. We can just see, is it green, are longs paying shorts, or is it red and shorts are paying longs? So we're actually going to zoom in on our current price action, and we can see it's slightly positive, right? Let's zoom in similar on our all exchanges. We can see that it's positive, but it's not hugely positive. We had a fairly significant flush out down here, which really shows us that many of those stop losses and the liquidation points were cleared out of the system. The market went significantly more bearish than what the spot prices were, and we've now rebounded. So at the moment, there's nothing in the derivatives market that's saying that we're likely to have a significant scale flush out. However, we do have to be aware that we are climbing in open interest, and that risk can quickly change if too many people are opening up levered longs or shorts. And in some instances, it can actually go both directions. You may see sometimes we get these candles where it trades up, closes out all of the longs, then trades down, closes out all the shorts, and you end up actually wiping everybody out of the market at the same time. And the price essentially goes back to where it started. So a lot of this is trying to tell us what's going on with the overall derivative space. If we look at futures volume, now this is something that's quite interesting. Note how we've actually got a fairly macro decline, which started around in May. We had a peak in volume in May, and we've seen this macro decline in volume. Now, this is quite interesting because normally what we see is a declining volume like this, almost in a triangular fashion. We generally see this during large-scale consolidation patterns. And one could argue that maybe the entire market is actually still digesting all of the first half of 2021, and we're essentially just going through a very big macro consolidation phase that can take multiple months. But we almost overshot during the first half of 2021. We had that initial deep dark correction during May through to July, and now we're essentially getting a bit of chop in both directions, up, down, and overall, if we look at this on a macro scale, this is basically a very, very large and sideways choppy consolidation. So certainly a playground for traders who are bouncing around within here, but it can also be quite challenging for hodlers who are essentially seeing it go green and then pull back in a very nasty way. Go green, pull back in a very nasty way. And that can play with psychology and overall investor sentiment. So it can be quite challenging. But what we're seeing in the volume is it may just look like a very, very big picture consolidation pattern. Now, just to close out on the derivative side of the equation, so this is a metric that is in the workbench chart that's in the Week Onchain newsletter itself, and I'll put the link to this in the show notes. What this is looking at is if we have open interest, we talked about how open interest can flush out the market and engage that kind of, it essentially doesn't matter what the spot markets are doing. If you've got too much leverage, it can push the markets around. So what we've got here is the perpetual market open interest. So this is the amount of leveraged contracts that exist. And we're dividing it by the size of the market cap. So another way to think about this, the perpetual open interest is kind of the force that wants to disturb the price, right? If we're sitting at the same level, but there's a high amount of open interest, it wants to move somewhere. It can be up or down. And then you've got the size of the object that's trying to be moved, which is in this case represented by the market cap. So it's the force trying to move it divided by the overall mass that's trying to absorb that force. Now, what we can see here is when we have these high values, note at the 64,000 all-time high, we had climbing open interest, which means open interest is climbing relative to the size of the market. More and more contracts being opened up at the all-time high, and then we get a dramatic flush out all the way through to May. So this essentially closed out all of that leverage, and the amount of leverage is now small. At these low levels, it's small relative to the market cap, so spot markets tend to take back over. Then we have, again, climbing open interest as the market's trading down, climbing until we get to the point where we actually have a short squeeze and it closes back out those levels. Now, note here that this is a very, very low level of open interest. And remember that over time, we're going to see more and more of this open interest start to creep into the market. There's more derivative-led price action. CME is now stepped in with the ETF. There's a whole lot of market dynamics. So these levels may not necessarily remain static, but certainly you can see that during this early phase of this bull, we've essentially had it pull down to this level. And where we're now getting is the short squeeze in July, pulled down to a level of around 1.06%. So that means that 1% or just over 1% of the market cap is essentially made up of open interest, or the open interest in the market is about 1% of the total market size. at the very tops here, we're talking about a very high level, 1.3%. So we're seeing a very high level of open interest where too many of these contracts are open up relative to the size of the market. And you can see we had the same event here in September. We had another flush out to a very similar level. Then as we pushed up to the $69,000 all-time high, we again had this increasing open interest and a flush out. So the take home from all of this is that we've seen a very significant deleveraging. We can see that on a relative scale, even though it's climbing, it's still relatively small. And the higher probability here is that our on-chain data and the spot markets are more likely to drive the market than the derivatives at this point in time. Until we see a significant change like this gradual climbing up or rapid climbing up of open interest, at the moment, it looks like spot and on-chain is more likely to give us information about what's going on and the sentiment in the space rather than derivatives. So that's kind of one takeaway from all of this. So now we're going to move into that on-chain space and just assess a few different layers to it. So one way that we can assess sentiment is by looking at coins that are being spent realizing profits, or are they realizing losses? Now what we have here on the left is realized profit and realized loss. So these are coins that were spent on chain. If we get this ripping higher of realized losses, it means that essentially top buyers who move their coins on chain at the top are selling at a lower price. And we can see this acceleration of overall realized losses. Let's actually zoom in over the last year or so. Now, with the converse of that is realized profits, where more and more people are taking profit, and you can see these spikes were climbing all the way into the all-time high. These are folks who are essentially cashing out and creating more supply. Some of these coins will be coming from cold storage, some of them will just be a swing trade, but essentially we're seeing more people selling into market strength, and what we're now seeing is a fairly substantial reduction in profit taking. Now, this is going to be a combination of things. One, obviously, when prices is lower, there's just less coins that are in profit. So therefore, they're more likely to realize a loss than a profit. That's part of it. But simultaneously, we also see this declining realized profit. Note here during the May, June, July period. Now, whilst this was a very challenging time in terms of price action, note how realized profits declined and declined and declined. Now, what is that telling you? When we get down here to 29, 30,000 and things are looking the absolute worst, it's telling you that the guy that bought down here at 10,000, at 6,000, at 600 is not spending his coins here at 30,000. So what we're seeing is actually a growing conviction and most likely a higher probability that these people are stepping in and buying the dip. So the lower the price goes, the more value they start to see in the market. They're less likely to be cashing out, more likely to actually be redeploying capital. The exact opposite is true with our realized losses. We see increasing and large amounts of realized losses as people who bought the top cash out at the very, very bottom, right? Generally, they sell the very bottom capitulation wicks, and we see those realized losses close down as the market rallies higher for obvious reasons. So what we're seeing here is a rising, right? As the correction continues, more people are realizing losses, which means top buyers are panicking, and then panicking even again. We have seen a breakdown at the moment, which can potentially suggest a slowdown in people who are capitulating. Potentially we're getting to the point where sellers are exhausted. But remember that because we're sitting on that 200-day moving average, there could be a lot of participants that are sitting there going, I'm waiting for the next move, and then I'm going to make a decision. Or when it happens, and they're expecting it to go higher or lower, if it goes the other direction, then they start panicking. So it can move in both directions, and we're starting to get into that, where is that line in the sand between the bull and the bears? Now, on a more bullish note, one thing that is quite notable, and we've spoken about this in a couple of videos, is the balance on exchanges and the net transfer volume. Now, very, very different to our May, June, July period where we saw about 168,000 coins on net flow into exchanges. Note how this downtrend has more or less persisted. We saw a very, the increase in exchange balances here is nothing compared to this. This took months to clean up, whereas here, basically the macro downtrend continues. So again, we've got a little bit of an uptick here. We need to see if that continues. Do we start to see a massive influx, which may be a loss of conviction and confidence? But really, at the moment, this is still looking quite constructive. We can see that on our net transfer volume to and from exchanges, I've got a 7-day moving average on this. You can see that we've had a couple of little green inflows, but by and large, we've actually got fairly substantial and actually in the grand scheme of things, quite significant and sustained periods of outflow. So again, this is kind of the data as it stands today. We need to pay attention and see how it evolves over the coming weeks. But right now, the conviction and the change in bullish sentiment still seems to remain, even though price action is quite grim. We're still seeing relatively bullish sentiment as an undertone. Now, the real question now becomes, what could potentially change that? Now, this is where we're going to look at things like our percent supply in profit, our percent of entities in profit, and our NUPL, which is our net unrealized profit and loss. So let me just describe what these all are and then how we're starting to assess why this could very well be almost a bull-bear line in the sand. So the percent supply and profit is fairly intuitive. We look at all of the coins and we say, when did they last move on chain? That's their locked in price or their realized price. How many of those coins as a percentage of the total supply are currently in profit? So if a coin was last moved at 20,000 and we're trading up here at 46,700, then it's going to be in profit. It's going to be classified as a percent supply in profit. And obviously those that are underwater or people who bought the top, coins that last moved at the top, they're essentially going to be in a loss. Now, what we can see here is that both our percent supply and profit and our percent entities in profit have naturally, from 100% at all-time high, declined quite significantly. We're currently trading around 71% of supply and 76% or thereabouts of entities. Now, note that this is a similar level to where we were at the line in the sand that we had back here in July. Now, what this also says is that some 30% of all coins in the coin supply have a cost basis that is higher. Essentially, a very large proportion of supply was last moved up in this topping zone. Now, what is the risk that those coins become additional sell side? Well, the lower that it goes, the more likely that becomes. Now, in terms of entities, this is where we measure the different on-chain entities themselves. We can see we've got a very, very similar pattern. It's back to where we were just below September, somewhere between September and July. So it's starting to point to maybe there's a whole lot of supply here, and really the bulls need to step in and really start to show some strength, because otherwise there's a whole lot of coins and entities on chain who very well could become sell side if we don't get some kind of strength in the market. And potentially when we combine that with our exchange balances, perhaps we see this start to revert, then we may have to start thinking about a far more bearish case. So these are some of the triggers that you can start thinking about to say what would actually define that bullish bearish transition, particularly as we hover around the 200-day moving average. It's kind of a lot of confluence of things playing on. Now, on a very similar note, we then look to our net unrealized profit and loss. So while this is looking at the percentage of supply or the percentage of on-chain entities, each of those coins, the coin that last moved at 20,000, and if we're currently sitting at 46,000, it's going to have $26,000 worth of overall unrealized gains. Now, when people have their portfolio, right, they see that their coins have gone up in price and now price is falling down, they see their portfolio value starting to fall. And that's what the net unrealized profit and loss metric is trying to measure. It's looking at how much profit is still left in the system, and potentially when is that, if it falls lower, are people going to go, you know what, I really don't want to see my portfolio go any more red, therefore I'm going to start de-risking. So it kind of brings it back into the financial or the monetary sense. Now I've got two of them here. I've got our standard NUPL, and note how we're essentially sitting at this 0.5 level, which in May, we sliced straight through it and entered a more bearish period. So, and then it actually offered as some form of resistance, right? So every time that traders moved back into profitability, they were essentially capitulating and taking whatever they could get and getting out of the market. And by the way, 0.5 here means that half of the market cap's value is unrealized profit. So half of Bitcoin's market cap is held as an unrealized profit. Now note that we also tested this level in the first part of August, again in September, and here we are testing it once again in at the start of December. So it is kind of that bull bear line in the sand. If we were to fall lower than that, it probably moves more into more bearish territory. And again, it's kind of serendipitous that we're sitting on the 200-day moving average. If we then look at just the short-term holder cohort, now these entities are most likely those who have actually bought the top. Because if we look at the 5-month period, we're essentially capturing all of the move post-May. So all of this latest move from the May, June, July sell-off all the way up through to the all-time high, this zone is captured by our short-term holders. And note that their level is actually at 0, which means break even. Overall, short-term holders are actually slightly below their break-even price. So what we're actually seeing is that those folks are already underwater, and during that kind of bearish trend, they tend to realize significant losses and capitulate all the way down, which again lines up with our realized losses, where during that period, we get significant realized losses occurring as short-term holders are exiting the market. And in theory, there's then stronger hands who are on the other side of that trade buying those coins. But it very much helps us describe this kind of bull bear line in the sand we're kind of at that precipice point where the market needs to really prove a direction, and likely the market will start to engage and we'll see how supply moves depending on which way the market goes. Very possible it could also just trade sideways, and we essentially see a whole lot of choppy, boring price action until it kind of condenses into a consolidation and then wants to move. So the very last metric that we're going to look at is called the 28-day market realized gradient. Now, what this tool does, this is actually something that I constructed a number of years ago. What it's trying to look at is the overall momentum of the market. So it's measuring, when we look at our price chart, so during a parabola, 2017 is a good example, when we see this parabolic rise, what we're seeing is that there's more energy with each rally. We get more and more vertical with each rally as we go higher. And relative to the realized cap, which is this orange line, that's showing the capital inflows. When a coin is sold from a lower level to a higher level, somebody else had to step in and buy that with more capital. So it represents capital inflows. And during bull markets, we get this uptrend in realized cap as old coins are revalued higher, new buyers come in, and it starts to be repriced. So with all of that considered, what the market realized gradient, which is this oscillator value that you can see here in blue, what we see is that when price has more momentum to the upside, we get these rising peaks. See how it gets larger and larger with each peak until we get to the blow off top? Now, this is not measured. It's showing that the parabola is getting more vertical, but it's getting more vertical relative to the realized price. So the realized price is kind of that natural, what is the natural flow of funds coming in? What is kind of the organic growth rate of the network? Now, when we see the overall market rallying, and capital inflows, it kind of tempers it. It brings it down. It says, okay, even though we're getting a parabola, we're still getting it alongside price appreciation, right? And more capital is coming in. So what we want to see during a bull market is these increasing peaks, which means that there's more energy and more momentum with each rally higher, right? That's a positive trend. As we move into a more bearish trend, you can see that a lot of the volatility dies down, and overall we get less and less vertical. We consolidate into a long bearish trend, and then we get that impetus back to the upside. So now let's zoom into the last couple of years. Notice how during 2021, we actually had rising price, rising peaks, right? Higher and higher highs. But at the same time, there was less energy. Notice how our oscillator was actually trending to the downside. We're seeing less momentum even as price is rallying higher. So that's starting to show that we're losing momentum. It's almost a bearish divergence is what we're seeing at the moment. Now, during our current rally, we had these higher peaks. So it was showing healthy momentum to the upside. However, this works in both directions. Note that on the dip in September, and now we have the dip in December, we actually have much more momentum to the downside. So it's really starting to point to the fact that the bulls need to step in and start to reverse this chart. And in terms of how to actually consider this as a signal, you can see in the bottom here, where we actually started to rally higher, and this metric started to trade much, much higher. We had positive momentum even though price was trending down. This is a bullish divergence. So we have price trending lower, but the momentum of this oscillator is actually trending to the upside. So you could see that we were getting more momentum to the upside even as price was trending lower. Now, what we really want to see in this current market for further upside is a technical reversal. We can see that we have this initial break higher. We want the gradient to start moving to the upside. And if you want full confirmation, it's actually when we get a full break above a value of 0, right? So that's what this red line is showing. Essentially, whenever this oscillator is trading above a value of 0, it's showing that overall the market has bullish momentum and is trading up to the upside. Conversely, when we're below it, it's showing that there's negative momentum. The market is preferring to trade to the downside. So what we want to see in this metric before we see further upside is a technical break higher. It's kind of our first indicator. And then for full confirmation, a break above a value of 0, which shows that relative to the capital inflows, the market on a 28-day basis is now pricing in further upside. So hopefully you enjoyed that deep dive. That's a bit of an exploration of some of our workbench presets. So you'll find the 28-day market realized gradient and its 142-day, which is a much, much bigger time frame. You'll find that in our workbench presets here on the left-hand side. And over here under our market indicators. And other than that, I will see you in the next week. Please give us a rate, review, subscribe, and put your comments in there. We're reading all of them, and we certainly appreciate your feedback on these videos. It certainly helps us understand what you're finding useful and how we can provide more to you. And I look forward to seeing you next week. Cheers.